tables across the city. Relish an upscale dining affair with the flavors of Mexico or Thailand. Enjoy an original cocktail in the heart of a Montrose district, or taste a local brew from one of our many local breweries overlooking our downtown skyline. Houston truly has it all. You may also be surprised to learn that Houston is one of America's greenest cities. Our region boasts 500 miles of interconnected bikeways, 380 developed city parks, and 170 open spaces. And we're not stopping there. Through the investments of Houston's top corporate and civic leaders, by the end of this year, more than 3,000 acres of unused land will have been converted to public park space. The transformation of Houston's Memorial Park is one of the largest and most visionary urban parks projects currently underway in the U.S. Memorial Park's 100-acre Eastern Glades opened this summer as a park within a park that features wetlands, a 5-acre lake, trails, and plenty of space to play. One of the more remarkable features of the master plan is the land bridge that will connect each of the prairie wetlands on either side of Memorial Drive with a 30-foot-high land arc. Always on the move, Houston prides itself for the dynamic and cutting-edge new technologies and innovations in architecture, infrastructure, and design. From the transformation of a downtown parking lot into the wildly popular 12-acre Discovery Green Park, to the $460 million expansion of the Museum of Fine Arts Houston by acclaimed architect Stephen Hall. This is where the world's brightest minds converge to define 21st century urbanism. As Houston is transformed into a modern, sophisticated city with rich cultural amenities, global cuisine, and lush green spaces, we have remained welcoming and humble. There's more to this great city than work. Houstonians live well and play hard. It's true, the grass is getting greener in Houston, Texas. A truly global city, Houston is home to residents from around the world. Our diversity creates a genuine cultural identity and a way of life that is uniquely Houston and world-class. We offer the cultural, recreational, and entertainment amenities of a big city, but at a cost of living well below the national average. Recognized as a culinary capital, Houston delivers its reputation with over 11,000 restaurants and bars, representing over 70 countries and domestic regions. James Beard award-winning chefs bring their unique fusion styles to tables across the city. Relish an upscale dining affair with the flavors of Mexico or Thailand. Enjoy an original cocktail in the heart of a Montrose district, or taste a local brew from one of our many local breweries overlooking our downtown skyline. Houston truly has it all. You may also be surprised to learn that Houston is one of America's greenest cities. Our region boasts 500 miles of interconnected bikeways, 380 developed city parks, and 170 open spaces. And we're not stopping there. Through the investments of Houston's top corporate and civic leaders, by the end of this year, more than 3,000 acres of unused land will have been converted to public park space. The transformation of Houston's Memorial Park is one of the largest and most visionary urban parks projects currently underway in the U.S. Memorial Park's 100-acre Eastern Glades opened this summer as a park within a park that features wetlands, a 5-acre lake, trails, and plenty of space to play. One of the more remarkable features of the master plan is the land bridge that will connect each of the prairie wetlands on either side of Memorial Drive with a 30-foot-high land arc. Always on the move, Houston prides itself for the dynamic and cutting-edge new technologies and innovations in architecture, infrastructure, and design. From the transformation of a downtown parking lot into the wildly popular 12-acre Discovery Green Park, to the $460 million expansion of the Museum of Fine Arts Houston by acclaimed architect Stephen Hall. This is where the world's brightest minds converge to define 21st century urbanism. As Houston is transformed into a modern, sophisticated city with rich cultural amenities, global cuisine, and lush green spaces, we have remained welcoming and humble. There's more to this great city than work. Houstonians live well and play hard. It's true, the grass is getting greener in Houston, Texas, and we invite you to join.
Hello, everyone. Thanks for joining tonight. We're going to give everyone else a little bit more time to join. But in the meanwhile, please watch this video about the property. Thank you. Everyone, thanks for joining this evening. We just wanted to jump on camera real quick and say hi to everyone. I'm Michael Lee.
Good evening, everyone. This is David.
Hi, Julia Buchowska. Hi.
Meryl Callister. Good evening, everybody.
All right, well, let's get started. All right, thanks again, everyone, for joining us this evening for our presentation of our latest multifamily investment offering, the Gallery at Katy. This, as we introduced a while ago, this is the lead sponsors on this is me, Michael Lee, Vyacheslav David Davidenko, Meryl Callister, and Julia Buchowska. Before we started, I did want to mention that this is webinar to discuss our offering. It is a private placement, right? This is an investment. Nothing's guaranteed here. So I'm not going to go and read through all of this, but everyone here should understand that this is an illiquid investment, and this is something that you'll have to make your own determination of whether this is a good investment for you, and there's no guarantees. Briefly go over the agenda tonight. We're going to cover the property overview and the executive summaries. We'll talk about the key players involved, which includes the sponsors and the operation players, and then the vendors that we have on our teams. We'll cover the surrounding market with Houston and Katy. We'll talk about our business plans and the capital budget that we have for the property. We'll discuss the financial analysis we've done and what we've done to mitigate risk. And then we'll go further into discussing the investment opportunity and the next steps to how to participate. And then we'll open it up for a Q&A at the end. So a high-level property overview is, as we mentioned, this is the gallery at Katy, and the property is in Katy, as the name suggests. It's 316 units built in 1983. The property has an average square foot for all the units, about 807. There's a mixture of 1, 2, and 3 bedrooms. Probably about 40 something percent is 1 bedrooms. Around 50 something percent is 2 bedrooms, and then the rest is 3 bedrooms. The property has been able to maintain occupancy strongly through the pandemic, and currently is at 94%. Right now, this executive summary. I mentioned the property has maintained occupancy well. It is in Katy, which is, for those not familiar with Houston, is in suburb in West Houston. In Cinco Ranch, in particular, is one of the strongest and most desirable master plan communities in Houston. So it's a very nice area that has shown a lot of resilience to the market conditions that we've had right here. The sub-market has strong absorption, which means that all of the available units there have been leased out relatively quickly. And that's really due to the population and job growth that's been happening in that area over the last few decades, really. I grew up in Houston. I've been here 40 plus years. And the growth in West Houston there has probably been the strongest area out of all of Houston. And right now there's only another one property under development within the 3-mile radius, which means that there's not going to be a huge amount of competition coming into market. So this property is well positioned going forward. We'll be purchasing the property for $36,250,000. Which is, a little bit more than $114,000 a door. The estimated raise that we'll be doing is $13 million. And as you can see there, we have, as the current rent is $997, and we think that it's below market rent, and plus some of the value adds that we'll be adding to the property, we think we can push the rents to $1,083. We also have a range of the investor returns there. It is a range because of the structure of the deal is we do have multiple classes for investors to choose from. And so depending on what you choose from, there will be a different estimated projected returns that you have right there. Our business plan will go into further down in the webinar, but at a high level, we have some granite countertops that we're going to install. The property already has washer dryer connections in all the units, but only some of them actually have washer dryer. So we're going to go and install washer dryers in the rest of them. The current owner has already shown that there's a premium for those type of units, and we'll have a Wi-Fi technology package installed and some reserved parking for some other additional income. And here we are to the key player section, and I'll hand it off to my partner David to continue.
Michael, is it fine with my sound?
Yes, hear you just fine.
Okay, let's go. So, guys, it's well known that a successful team in almost any business should consist of people with complementary knowledge and skills. And moreover, in a best case scenario, those team members should have some experience of working together before. And looks like in our case, we have all this. What am I talking about? Let's start with our team knowledge and skills. So among all of us, we have 3 MBA degree holders, we have 1 CFA, 1 PMI certified project management professional, 2 co-founders of 1 billion mixed use new development project, plus 1 co-founder of another mixed use new development. Moreover, one of our team members bought, rehabbed, managed, and later sold 9,500 of single-family homes. All of us together invested as a general partners and limited partners in more than 75 multi-family properties. So talking about our experience, yes, we have it. And at the same time, we were able and really lucky to share all the responsibilities related to this project. So it's great. Let's start and provide some additional information about us individually. Michael Lee, accredited full-time investor from Houston, invested in more than 4,500 units across 26 different properties. Michael and myself closed 6 multifamily properties together. So it's not our first deal. And our first deal, we have sold with more than 40% annualized return for our passive investors. And what should I say here also? One sec. Sorry, there is some noise. Talking about Michael, that Michael is currently in the process of getting his CCIM degree. About myself, I'm a accredited full-time investor from Austin, invested in almost 4,000 units across 22 different properties. My last deal was 25 million, and I closed this deal with a single investor being a single general partner. I have 4 kids. My eldest one is 30 years old. My youngest one just turned 1 year, 1 week ago. Meryl Kalizer, our partner as well. So Meryl is the owner of the boutique commercial real estate law firm. He's a serial entrepreneur and accredited investor like all of us. Meryl started his career as a bankruptcy and restructuring lawyer. 8 years ago, Meryl started new business buying, rehabbing, managing, and selling single-family homes. Let's say that all in all, he sold more than 9,500 single-family homes. And Meryl is my partner in 1 billion mixed-use new development project. So this is not our first project working together. Julia Bychovskaya, she is an accredited full-time investor from New York. Julia is a chartered financial analyst. So she started her investment career in 2003, worked for Credit Suisse, BNP Paribas in New York City. Moreover, Julia is a founder of a very successful corporate housing and short-term rental hospitality company. So Julia brings a lot of experience in our project, including experience related to short-term rental. And we worked with Julia in several projects in several deals that we closed together with Michael Lee. And talking about another part of our team, 4 of us, we are lead sponsors. It means that we are the leaders. But anyway, this is not the whole team. This is not the full team. We have 5 more co-sponsors. Let me provide you a little bit more information about Hoa Nguyen and Jaime Gonzalez. They're a very successful couple. They husband and wife doing business together. So right now they own 2 multi-million-dollar optometric practices and have 16 employees who work for their business. Their multifamily focus is Texas, Arizona, Florida, and Georgia markets. during our due diligence, they were one of the crucial parts of the whole process. So everyone was really actively involved, and our other co-sponsors as well. It's my regret that I'm limited in time, so I have no choice but to ask you to read more about our other team members in the pitch deck that we plan to distribute among all the webinar participants later. I just need to say that all of our team members are the real professionals and experienced real estate investors. Thank you. I see that, Meryl, you are the next.
Thank you, David. So I'm here to talk real quickly about some of the advisors that we're utilizing. The first is Calcer & Associates, obviously has the same last name as me. We have a national practice in commercial real estate and syndications. We've represented well over 1,000 multifamily syndications over the last 8 years and over 4.2 billion in actually asset value. So lots of experience there. We also are utilizing Engineered Tax Services. They are a cost segregation specialist that's national. They've got offices in, I believe, 25 cities. They're utilized by most of my clients, and we have utilized them in the past, as well as many of you guys that I can see on the list. Their preferred, their analysis that they provide is special because they use actual engineers to go out and do the analysis rather than a calculation. So I don't want to say it is bulletproof, but it's almost bulletproof if ever challenged by the IRS. And then we're also using Saville & Associates, a local CPA firm, a very large local CPA firm with over 130 tax and accounting professionals, very experienced in real estate transactions nationwide. Walker Dunlop is providing the financing on the multifamily side. Again, another national broker with lots of ties to the agency financing world. And then we also have utilized J&T Developers, general contractor. I've used them on several of my deals, and lots of our clients have used them. They've provided due diligence, checked out the roofs, checked out the exteriors of all of the buildings, and have been very helpful through the diligence process. And one of our biggest providers, most important providers, is Disrupt Management. Disrupt Management is the property management company we've chosen to use. They are currently located in Texas and Georgia. They manage assets in Texas and Georgia. We like them specifically for their technology. It is rare to have a property management company that is kind of in the forefront with technology. So we're very technology based. We're happy to use them. We have open access to all of their data, which is very good for us being asset managers and having a lot of IT background. Allows us to analyze the data in real time very quickly. They're 100% transparent, and they were a huge help in going through our due diligence and having teams of 6 or 7 people each day out there walking properties, going through units. So we're very excited to have them on board. I'm also going to talk to you guys real quickly about just the general property information from a high level. Basically, as you can see, I'm not going to read everything here, but the asset's built in 1983. It's in great, great condition. Over $3 million in CapEx, capital expenditure, has been put into the properties since 2016. Occupancy as of right now is 94%. This slide is based on last month. So they're at 94%. It's a B+ asset in an A to A+ area, great area. Pitched roofs. We love pitched roofs. Don't like flat roofs too much. We have a CapEx budget of $700,000, a little bit north of $700,000. Whether it all is needed or not will be determined, but that's what we've estimated based on our due diligence. And we're going in at a purchase price of $6.25 million, which is about a 4.9 cap rate. And we've got an exit or reversion cap rate of 5.25%. And briefly, I'm going to go over some of the exterior renovations that have already been done so you guys can get an idea of the quality of the asset. Both pools have been remodeled, new pool furniture. You can see the multi-purpose sports court from our drone video of about 1,000 feet up. It's beautiful, very colorful. They've put new gates on all accesses to the property. It's a completely gated property, so new sliding gates. One of the biggest assets that we like about this is all of the buildings have new roofs. And for a property that is 316 units in Texas, that is a huge cost savings for us. So they've actually put a lot of CapEx into these units. As far as interior renovations, as you can see through the pictures, their upgraded units have stainless steel, new cabinet doors, resurfaced countertops. The backsplash are all tile, put new flooring in. They did a renovation of their clubhouse, a renovation of the office, a beautiful office when you walk in. They renovated the fitness center, as you can see in the bottom left, new machines. They've got video on demand workouts. They even have a indoor half basketball court / racquetball court that when we were there, we saw a couple kids playing basketball in there. It's very good for rainy days. And then in the bedrooms and the interior rooms, they've got an upgraded lighting package with 2-inch blinds. So they've done a very good job on the units that they've upgraded. And we would continue to do that type of upgrade moving forward. So now I'm going to hand it back over to Julia, who's going to do the market analysis.
Thank you very much, Meryl. I appreciate it. Can you hear me all right?
Yes.
Perfect. Thank you. And good evening, everyone. So I'm going to go over investment highlights for the property. There are a few things that we would like to highlight here. Number one is the CapEx that the current owner has invested in the property is over 3.25 million, so 3.25 million since 2016. And they invested in both exterior and interior renovations. On exterior side, I think the major one is the replacement of all roofs, which is great for us because A, we don't have to deal with it, and B, as you know, if the roofs are not replaced on the property, which is 30-40 years old, it could turn into a major issue, which we don't have to worry about right now. And they also, as Meryl mentioned and showed you some pictures, they upgraded the fitness center, the club room, the pool, landscaping, so the property shows very well. And they also have done interior renovations, and we walked all units. They have stainless steel appliances, they have backsplashes, new flooring, lighting, and they look very nice. You know, I would live there myself. So that's on the CapEx. Also, one of the main advantages of this property is its location. Demographics is just amazing. As you can see, the average household income in 1 mile radius, and that's the radius that multifamily investors focus the most, is 95,000, which is very, very high. And it just shows that the area has affluent demographics in there. And, you know, we have average rent of $997 right now. So this property is very affordable for the people who live in the area, which is great for us, obviously. And 36% of the households have average income of over $100,000. Again, that's just a very, very high number. And we look at a lot of properties when we do our analysis. We underwrite a lot, and I can tell you from my experience, it's very rare. It's truly rare. You don't see those type of income levels very often. So we're very pleased with that and very comfortable with the area. Finally, on this slide, I would like to comment about the school district that we have in Katy, which is very famous in the state and around Houston. And I personally did market survey of the properties nearby, and I talked to on-site property managers of probably 6 or 7 properties. And all of them, with no exception, they did mention how great the schools are and that the tenants love living in Katy and in this area because of the schools. You know, is one reason, and the other reasons they mentioned was proximity to Houston, which is only maybe 25 minutes away, and there are also a lot of local jobs. in the area. So on this slide, we have an area map, and this circle is a 5-mile radius circle. So you can see from the slide that there is a lot going on in the area. It is very densely populated. There are tons of stores, retail, supermarkets. So the green dots on the map, they show supermarkets, and you have a gazillion different kinds of them. You have Whole Foods, you have Kroger, you have Farmers Market, you have Sprouts, Farmers, so a lot of different supermarkets. There is a Starbucks 1 mile from our property, from the gallery at Katy. There are also a lot of retail stores, and also you can see that there are several hospitals in the area, which we like very much as well. And last but not least, if you look to the right of the circle, you see that there are 3 large business districts. One is Energy Corridor. Also, there's a West Chase District and Memorial District. And all of them employ tens of thousands of people. So this is just a great area. And of course, you know, if you look to the left of the circle, you see some warehouse, downtown Cinco Ranch, which is a very luxury upscale area with amazing restaurants, amazing retail, and it just shows very nicely. We also wanted to highlight that the area does have a lot of healthcare employers. We love healthcare because it is more resilient and more recession resistant, and the employment base tends to be very stable. So with this area, we have 4 large hospitals, including Methodist West Houston Hospital, the Texas Children's Hospital, Memorial Hermann Katy Hospital, and lastly, MD Anderson Cancer Center. So we feel very comfortable with this area because of that, in part as well. So here you can see that there's tons of retail in the area. You have tons of options of stores and restaurants and different shops. So that's good for a couple of reasons. A, our tenants can go and shop. I would if I were living there, of course. But also it's jobs, right? So you have a location which has a lot of retail and a lot of people, the demographics who live on our property. Some of them, they work on those retail locations, and it's only 5-10 minutes drive at most. So that's great as well.
Julia, I'm sorry for interrupting you. Dear participants, this is our second webinar today, and it looks like Webinar Jam has some issues today with the hosting company. So in a case, if you lose sound or your video becomes frozen, please click the button Reconnect that you have at the very bottom of your screen. Just try to reconnect to the webinar and it should help. Sorry for interrupting you again. If you lose voice or sound or video, please click the button Reconnect. Thank you.
Yes, and we do apologize on behalf of our webinar service provider that is not working 100% as we expected, unfortunately, but we'll get through it, and we'll also send you a replay, of course. Next, I just wanted to show you guys a couple of aerial shots of the property. So you can see a picture which shows that it is a densely populated area. There is a lot of single-family houses right next to the gallery at Katy. There are a lot of schools. On the left side, this road is called Mason Road, and on the left of it, you see tons of tiny or medium-sized businesses. Some of them are retail, some of them are restaurants, nail salons, barbers. So there is a ton going on. It's a very, very busy area. And I personally spent maybe 3 days just, riding up and down this particular road. So a lot is going on. And on this slide is just the same area from a different angle. Also, you see a lot of properties, a lot of houses to the left of it, behind it, in front of it. I want to mention that there is a public storage facility right next to Katy, so it's an extra amenity, I would say, that our tenants have. Obviously, you have to pay for it, but it's right next to you, so it's very convenient as well. And again, you see a lot of schools, a lot of retail, and a lot of restaurants in the area. And with that, I would like to turn it over to David to talk about our business plan.
Julia, is it fine with my sound?
It's wonderful.
Okay, thank you. Talking about business plan, what should I start with? That this is the B-class property located in a A-class area. And what it means that business plan is quite different from what we are doing at our other properties located in C-class area. If you buy something that was built in 1960s, 1970s, located in the area with median household income, let's say 35 to 45,000, you should upgrade your units, and 60, 70, 80% of your whole budget goes directly to rehabbing your units. So you replace flooring, you work with the countertops, backsplashes, you're replacing cabinet doors, and so on and so forth. And this is maybe the best proven way to increase your rents, to implement your business plan, and as a result, to execute it and deliver returns to your investors. When talking about B-class property that experienced investments from the previous owner higher than 10,000 per unit, for sure, business plan should be quite different. We have no choice to replace flooring or to install backsplashes and so on and so forth. So we are working differently. What do I mean? One of the main sources of additional income for us is GigaFi. And GigaFi isn't well known for C-class property owners. B-class property owners could know more about it. So let me share with you some information about this product. What do I mean? What am I talking about? So, GigaFi, it's a high-speed internet for residential buildings. GigaFi installs a wireless or fiber internet connection into the property, and then they install those lines and connect every unit to the internet. And in this way, property owner becomes internet service provider himself. And moreover, what's interesting that we have some initial investments, but after that, we receive 100% of all the revenue generated from selling internet to our tenants. And GigaFi, they only charge us some really small monthly management fee, and they provide full support and management of the network that really works for us and our tenants. As a result, what our tenants have? Our tenants have internet available from the day one, then they just moved in. So they don't need any long-term contracts. They have month-to-month billing. They could downgrade or upgrade at any time. And there is no front fee for them. Of course, if we discover that we could charge this upfront fee, maybe we will be doing it, but at least we don't have it at our business plan right now. What are the benefits for us as a property owner? So we have full wireless coverage throughout the whole property. Each unit has direct connection to the internet. and we have an ability to use this internet connection in common areas because this property has a business center, and being a business center, our tenant just could make their job. No additional equipment required for us because GigaFi provides us everything. And if something happens, if we have our internet down, we have technician from the large and well-respected company. So this is one of the main parts of our business plan. Reserved parking. It's interesting that property located in A-class area doesn't have reserved parking and carports. So that is why our business plan is to implement reserved parking and carports over next 2 years after closing the deal. Every unit at this property has washer and dryer connection. And another part of our business plan is to provide our tenants with washers and dryers. According to the business plan, out of 316 units, in 2 years, 175 should have washer and dryer from us as a property owner. It means that with the reversion cap rate equals to 5.25, we should be able to create additional value that is more than $5.5 million US. Talking about other value add, it's related to interiors. Yes, we are going to upgrade 50 units, and it will be so-called luxury upgrade because everything again related to countertops, flooring, cabinet doors, light fixtures, bath fixtures, everything was done by current owner already. So what we plan to do is to install granite countertops in kitchens, upgrade fireplace surrounds, and install patio enclosures. Our total budget for capital expenditures in this way equals a little bit more than $700,000. And you could see that interior upgrades $175,000, washer dryer $193,000, GigaFi Wi-Fi $158,000, water conservation that I didn't mention, it's another value add equals to $134,000 that we plan to spend, and carports $45,000 more. Let me start financial analysis. I will just comment, let's say, 1 or 2 slides, and then Michael Lee will continue. So the question that is really very important to all of us as multifamily investors or owners, what has changed with the COVID issue, with the pandemics that's around? We see that some businesses like hospitality or everything related to air companies, they experienced huge losses. They really struggle. But we know that for multifamily, at least as of today, this is not the real issue. If we are talking about our own portfolio, I have mentioned that together with Michael, we invested in 6 properties and we still own 5 of them and sold 1 more, delivering to our investors more than 40% of annualized returns. And for B-class properties, they really don't struggle at all. Nothing has changed. Our West Creek or Wichita Falls portfolio, they are almost always 95 to 100% occupied, and our whole delinquency, it's close to 1 or 2% only. Talking about C-class properties, yes, it's not that easy. For C-class properties, we are 90 to 95% occupied. We have 5 to 7, potentially maybe some months even up to 10% delinquent. So those properties, they experience some issues. But looking at this property, they see that at the worst months, let's say July and August, this property was down just 4% in terms of net rental income. Anyway, in September and October, net rental income started to grow. And by the way, we see the same trend at our Wichita Falls and West Creek properties, fully stable during the coronavirus time, or even growing, even improving their financial results. Michael, please.
Yeah, so here's a slide of the rent comps for the area. These are properties that are nearby our property, and we feel that are good competitors in terms of size and age and location. And what we're trying to show here is basically that we think that we're well positioned in terms of the rent. We see that these properties are already achieving rents that we are looking to push up to. So we feel like the property is under rents. And in addition to that, we, as David mentioned, we do have some other value adds that we plan to add to get some additional income on top of that, like the granite countertops. Some of these properties here have already implemented that and have already proven the market out that they are able to get the high rents. For example, number 3 there, Terra at Park Row, one of their units, they do have granite countertops, and you can see there that there is quite a bit of difference between what they're getting in the market rents and what's currently getting achieved at the gallery.
Michael, sorry, while you didn't start talking about our loan terms and projections, let me start our poll. Dear webinar participants, please pay attention to the right side of your screens, and if you have a chance, please answer, please participate in that poll. Thank you.
Yes, thanks everyone. So here are the loan terms. This is a non-recourse agency loan. The agency in this case being Freddie Mac. Our lender is Walker & Dunlop. We've done deals with them before, so we're familiar with them and closed the last deal smoothly with them. The loan amount is $26 million, which comes out to roughly 71 to 72% on the value of the purchase price. And that number, these numbers can change. Normally, we don't get our loan rate lock until about a week before the closing. But all indications right now are showing at $26 million with a 3% interest rate on a 10-year loan term with 5 years of interest only. And we get the 10-year loan term, even though we are projecting off of a 5-year hold. We understand that the market's conditions can change, and we want to have the flexibility such that if in year 5 we decide that the market's not conducive for us to exit the property at the time due to maybe a recession or whatever else, that we have the flexibility to hold on to the property if we need to. And that's why we don't get 5-year loan terms or 7-year loan terms tied too closely to what the business plan is, but really more to give us some more flexibility. And one of the things I really wanted to point out is the prepayment of 1%. And generally, these commercial loans have heavy prepayment penalties. You might have heard of the term yield maintenance or defeasance. And these type of yield prepayment penalties in the past could have come up to be 15 or 20% of the overall loan amount, which is makes it very hard for you to exit the property if you don't have the right loan. So we're very excited to have something that gives us the flexibility, which takes us down to the exit strategy. We have the ability, obviously, to go through with our business plan, which is a 5-year hold. But if we're projecting, if we're hitting all of our projected numbers after year 3, and we decided at that time that the market conditions are right for us to do a refinance, we could refinance at that time. And based on our projected numbers, that would give us the opportunity to get back 60% of the invested capital back to the investors, which overall really lowers the amount of risk that everybody has in this, because the amount of money you have invested is lower, but we're still be cash flow, owning the property and cash flowing. And then option three is kind of what I've talked about previously. It gives us the opportunity to hold on to the property the full length of the loan term if we need. The nice thing about it is that we feel like this is a very nice property. There's a lot of money you've already spent on it. The deferred maintenance is very low, and it's in a great area of Houston. And so we know even if we hold on this property for 10 years from now, Cinco Ranch will still be Cinco Ranch in one of the top neighborhoods in Houston. Here's going to the section of our financial analysis. Here's our overall projected returns. This is specifically for the Class B shares, and we'll talk later on further about the various different share types that we have for our investment. But if Class B shares at $100,000 investment, you can see we have about roughly 85% total returns, and the total returns is a combination of the cash flow that we have throughout the 5-year hold. And then at the time of sale, we also have the capital gains or appreciation component of that. And that together comes up with around 85% total return, which is, comes out to roughly around 16 point something percent for annualized return. And then you see the cash flow there is roughly 11.5%. And measured on an IRR basis is 15+%. As we mentioned, all of our numbers is based on a 5-year projection. That could go faster, that could go longer. At this stage in the game, we think 5 years is a good hold, but potentially it could be 6-7 years. And that's one of the things that you'll have to understand when we say that this is an illiquid investment. This is not something like your stocks or equities that you can get and sell real quickly. At the bottom there, you can see we've got a few things in the matrix for you to look at. One of the things I wanted to point out is in year 2, the cash flow is a component of the cash flow is the operating income that we're able to distribute out. But a part of it is I've got it labeled as escrow return. And what that is right now during the COVID pandemic, the lender is requiring that we escrow 9 to 12 months of your principal and interest that's owed to them for the year. And in our case, they're saying right now that they want us to escrow 9 months. And the whole purpose of that is obviously for them to lower their risk. They know, and just like us, and no one knows what the impact will fully be over the period of the time. So for right now, to protect them, they're requiring that we raise enough money up front to make sure that they get paid on their debt, regardless of what happens. But if the property after a year, if the property's operating well, we're able to get that escrow money back from them, and we plan to return the money to the investors, and that'll be a return of your money. And that's why you'll see on the second column where your amount invested initially was $100,000 goes down to $93,000 because the amount of money that you have invested in the deal has gone down. Here's our cash flow model, which shows all the gross potential rents and the money, the income coming in, the expenses, and the money's left over after the debt service. And what we want to point out is that in year 1, as you can see, we have circled in red there, we are projecting a 0% income growth for the entire year. Now we're not necessarily projecting that, but we're modeling that, right? We anticipate that there will be some growth, as David showed earlier with the net rental, where we're already seeing that September and that October income's already increasing, and even the other months that were slightly impacted, they didn't really go down all that much. But we're not modeling that way. We're trying to be a little bit more conservative, so we're modeling as if there's no income growth at all in that first year. And then, as I mentioned earlier, the return of the lender escrow, we've modeled it in year 2. So we anticipate we'll be raising about $1 million for the escrow. We'll be returning $800,000 of that. That means that other $200,000 will be saving for additional capital expenditures, which we do have in our budget that David already talked about. At the bottom there, you'll see the reversion cap rate, also known as the exit cap rate, and basically is what's our anticipated cap rate at the time of the sale 5 years from now. Is a number that we're projecting. A lot of the experts right now in the industry are actually anticipating for that cap rate number to continue to go down, which means the prices will go even higher. But we're not modeling it that way. We're buying it at 4.9 right now, and we're anticipating, we're modeling that the cap rates will expand up to a 0.35%, which is 35 basis points up higher. Here we're going to be going over the stress tests, and basically what we're trying to model here is what would be the impact to the property in case if our business plan doesn't go the way we would want it. Because we are we're buying this property obviously because everyone wants to be able to make a profit, but our primary concern is to have conservation of capital, right? So the number one thing for us is to not lose our investors' money, and then secondary to that would obviously to make a profit for all of our investors. So how do we do that? So we've modeled 3 different ways. One is, what if there's no income growth at all across all 5 years? What does the deal look like at that time? What if the rents actually drop in the first 2 years and then stays low? And then the third scenario is we wanted to see what is the maximum amount of vacancy we can have and still be able to make debt service to our banks such that we can pay them and not have to hand over the keys to them. So let's cover that real quick. Here's the model for the 0 rent growth. As you can see there, across all 5 years, we have 0 rent growth. We have 0 growth on the other income piece of it. We're still modeling a 2% expense increase because that's going to happen regardless of how the property, performs, whether we're able to get the rents or not. The expenses are going to still be there. They don't go away just because we're not getting the rents that we want. So we're modeling that in, and as you can see at the bottom there, even after debt service, we're still cash flowing. This is not obviously the ideal situation. But it shows that even with that, we're able to cash flow. Here's another model of showing what if the rents drop. Here we have it modeled for a 5% drop, which comes out to be $200,000 in year 1, and another 5%, which is another $200,000 in income drop in year 2. And then years 3, 4, and 5 doesn't go down any further, but it doesn't go up either. So it just stagnates there. And the expenses obviously are still growing. So what happens in that time? You can still see at the bottom, even with that model, we're still able to cash flow. As I said, not ideal, but we're cash flowing. And here we are, we're trying to model what is the maximum vacancy as we can achieve. And as you can see at the top there, vacancies of 40+%. And at the bottom there, it shows the DSCR, which is the debt coverage ratio of 1%, which means we're making enough to cover exactly the amount of the debt service. And so in this case, you can see, very horrible situation to be in at 40+% vacancy, but we're still able to make cover to the bank. I talked about earlier about the exit cap rate and what it could be, and we had modeled already that the cap rates will increase from the current numbers that we're buying at right now, which is the middle, the target right there. But what if we're wrong? What if the cap rates go up higher than expected? So what if it goes up all the way to 5.5? As you can see there, the cash flow stays the same. It just impacts the overall returns because the capital gains of what we can sell it at is going to be a little bit lower, but it still comes out to be a total return of 65 to 75%, which we feel is a very strong number, even with that model. But conversely, if we are wrong, but wrong in the other direction, which is the cap rates continue to go down, like a lot of the experts are saying, in that case, then the numbers can be better than we're projecting. All right, and sorry, right here, Julia, please, can you please take over?
Sure. So here we want to talk about cost segregation analysis. As a real estate investor, one of the great benefits that investing in real estate provides, you can generate very substantial paper losses by using so-called bonus depreciation, which allows you to materially boost depreciation deductions in year 1 of ownership. The idea here is simple. So when you buy a real estate, then the purchase price is allocated to land, which is not a depreciable asset, but also to the building or real estate itself. So in our case with the gallery, we're buying it at 36.25 million. The value allocated to the real estate is 29 million. This is an estimate, right, from Engineered Tax Services, our service provider. So what you can do as a real estate investor, and what we are going to do, of course, you can hire a firm like Engineered Tax Services, and you can ask them to go to the property and analyze everything the property has, and reassign some of the items to personal property versus real estate. And personal property could be such things as wire, window coverings, roofs, light fixtures, flooring, etc. So after they do such analysis, they would allocate categories to personal property categories, which are usually have useful lives of 5, 7, and 15 years. And even though the useful life is years, current tax law allows you to take the whole amount of all this personal property value and depreciate it in year 1 of ownership, which is great because it creates a huge tax loss. So even though you are not losing money in reality, you're making money, your tax statement, your K1, will show a huge tax loss, which depending on whether you're active or passive investor, and if you meet the IRS definition of real estate investor, but you can use those losses in any event, regardless actually, but just the laws are different, but you can use those losses in your, on your tax returns, either to offset your active income. If you have a spouse, for example, who is on W-2 and you are a real estate professional, you can have huge, amazing savings from that W-2. And that's what a lot of my friends are doing. And I highly recommend it. I call it God's gift for couples, really. So in our case, going back to Katy, we have about 9 million, as you can see, on this blue line, allocated to personal property. That's an estimate, but that estimate would translate into about 70 to 90% of your equity investment as a paper loss in year 1. So if you invest, let's say, 100,000, you potentially could see 80,000 loss on your K1. During the year you invest, which is amazing. And here we just want to cover the fees that the sponsor team has in our property PPM. So asset management fee is 2%, which is standard. That's what most of our peers are charging, and this is just goes to cover the expenses that we're going to incur asset managing the property. We have to fly there. We have to, constantly have conversations with the third-party property management, which we are hiring, which is Disrupt, and so on. So that's asset management fee. Acquisition fee is only 1% here. Most of the deals we see have higher acquisition fee, so it's a investor-friendly structure, I would say. Usually it's 2 or 3%. Sponsor compensation. So here, as a sponsor, we would get 30% of the operating cash flow after the equity investors get their preferred returns. And then at sale, we also get 30% of the profits, but only after the equity investor gets their preferred, which is, if we cannot cover preferred, and well, actually, that's so it accrues. I'm not going to go into the details. Meryl can cover that as our attorney, but so the sponsor will get 30% after the preferred plus the initial investment amount of the initial capital are returned to equity investors. And equity investors will get the reverse of that. So they're getting 70% of the excess operating cash flow after the preferred return. And at sale, they also get first their preference, then also their capital that they invested originally, and finally 70% split on the profits after that. So with that, I would like to turn it over to Meryl, who's going to talk in more detail about our equity structure.
Hey, everybody. I've seen lots of questions about the classes, and we saved the best for last, I guess. So I'll be talking to you real quick about the 4 different classes we have, and then Michael's going to wind it up and tell you how you guys can subscribe. So we have 4 class structure: Class A, Class B, Class C, and Class D. And as you guys know, we have already done one webinar earlier today, so I'm going to answer some of the questions that were asked during the first webinar. We had quite a few people on the first webinar, so this will probably alleviate some of your questions. So to start off with, classes A, B, C, and D all share in accelerated bonus depreciation. There were several questions about whether Class A did or did not. It does. So Class A is what we call kind of like a debt class. Debt class meaning the minimum investment is $75,000. You have a 10% preferred return annually. Once the property is sold or there's a cash out refi, your capital gets paid back, and then you're done. There's no back end profits based on gain, but you have a 10% preferred return. So you have a preference. You also have what's called a preferred return, meaning you get paid your 10% before the other 3 classes get paid their preference. They have preferences as well, but their classes, they get their preference on a pro rata basis. So you're paid first, then Class B, C, and D are paid pro rata. They're paid together at the same time. So at a 10% return, it's kind of obvious. 5 years, you'll have a 50% return on your money. Upon sale, you'll still end up with a 50% return on your money, and you get your capital back. I want to stress there are very limited, about a handful of these shares left. We did have quite a few people that took over these shares from the webinar we had at 1. So if you're interested in this kind of debt class, it's a new class to many of you. Basically, it's a coupon. You're cutting a coupon every year like a treasury bill, except you're getting paid a much higher return. So if you're interested in Class A, you need to jump on those. The second class is also a very unique class. It's Class B. This also has just a handful of units left. The minimum investment on this one is $400,000. What we had decided to do was we wanted to give a preference to those that wanted to put a lot of money into this deal. Many people have, well, I'd say many, several people have already subscribed for the $400,000 class because they're looking for the bonus depreciation to offset that. We're offering a 9% preference on Class B. The annualized, the annual cash flow is going to average about 11.55%. The IRR is 15.2 over a 5-year period, and we're anticipating a 1.85 equity multiple. So as I said before, Class B, C, and D, they get paid on a pro rata basis. Class A is preferred. After the preference on Class B, they share on a 70-30 split with the managers. So every dollar afterwards and after their capital is paid on cash proceeds from sale or refi is split 70-30. So they do get back end. Class C is $100,000 minimum. And we have, I think, several units left on Class C and Class D, as we made those the highest number of units available. Class C has an 8% preference. As I said earlier, it gets accelerated bonus depreciation. Annual cash flow is a little bit lower than Class B because of the preference. It's a 10.82% annualized return on the cash flow. The 5-year total return, assuming there's a sale based on our projections, it's about an 82% return. And it comes out to be a 1.82 equity multiple. Again, classes B, C, and D share pro rata as they're receiving their preferences. And then there's a 70-30 split with the manager on excess. And finally, we have a class D, which is those that want to invest the bare minimum that are accredited. The minimum investment in class D is $75,000, 7% preference. Annualized cash flow is averaging 10.09%. It's about a 78.61% return based on the same estimated reversion rate. And it's a 1.79 equity multiple. Before I pass it over to Michael, I want to reiterate or answer a question that people had before. We have some investors that are buying Class D and Class A units. I guess they're kind of hedging the potential risk of waiting till the very end to see what it sells, with half of their money getting a 10% return on investment. So hadn't really thought about it at the time, but it's actually a nice hedge. So without further ado, I'm going to pass it on to Michael.
Michael, before you start, dear participants, let me attract your attention to the right side of your screens. We have started our poll. Really appreciate if you could share your preliminary plans, your preliminary opinion. What class of shares do you prefer? A, B, C, or D? Thank you.
Yeah, so right now we're just going to talk quickly about the subscription process. There's a link here that you'll get in the email too. You click on the link and it'll take you to our investor onboarding for the next steps in the subscription process. So you'll get a subscription booklet via the DocuSign that you can read through and you can sign. At that point, that shows that you have interest, and we'll take it a step further to go through the accreditation process, which is required because this is a 506c investment, which by the SEC rules requires that you are an accredited investor. And there are 3 ways that we can achieve that. You can have an affidavit signed by your CPA attorney or investment advisor and returned back to us. We also partner with a third-party law firm called Verify Investor, verifyinvestor.com. And it is a service that we pay for, but you will work directly with them, and they will ask you for some documents to kind of verify that you are accredited. And then the third option is either an affidavit or a certificate that you've already done, maybe in the past 90 days for a previous investment that you've done. And just to let you know that once that is done, and we get the accreditation certificate from or the affidavit from your CPA, then we'll be able to continue forth and share with you the wire instructions. And then to reiterate that we do have a preference for higher capitals, and that's kind of why we've structured the deals the way we have, with a higher preferred return for those numbers. So first come, first serve, and obviously the higher the more you invest, the better. Right now, this is the projected timeline. We've signed the contract at November 4th. Today is the webinar, and we've got it down there as December 17th as completion of the equity raise. But frankly, we anticipate the raise will be done within the week, if not just a few days. We're having a lot of interest already. A lot of documents have already been sent over to us. We think this opportunity will go quick. And right now we have the target closing date as December 29th. I want to speak a little bit about that just because we have the full intentions of closing this year. Our contract date, as you see there, it was November 4th. We've actually sent in the application for our lender on November 2nd with a $45,000 application fee to attach to that, because we wanted to get the process moving along as quickly as we could and give as much time as we can. And so we wanted to give it nearly full 2 months for the closing process. And we've never had any of our properties take longer than 45 days. That being said, it is our understanding that there's a lot of deals closing at the end of the year. And Freddie Mac, the agency, is getting overwhelmed, and so we don't want to promise that we'll be able to close this year. We'll be pushing as hard as we can, but if you absolutely need to close this year for purposes of taxes or whatnot, then just take that into consideration. And so if you have any other questions, here's a list of all of the sponsors involved, the lead sponsors, and in addition, you have any questions, send to investors@katymfund.com or to one of our emails, or give us a call or a text. And at this point, we'll be moving into the Q&A section of the investment. And David, I believe you also want to be pushing out some stuff, right?
Yes, it's done. So we will be answering your questions right now. In a case, if you are interested in investing in our deal and don't want to wait for our emails with all the links, please pay attention again to the right side of your screens. Push the button Invest Now. The new window will open. You need to fill just several, let's say, cells there. What class of shares do you choose? Are you investing as a private person, as LLC, and so on and so forth? And in response, you should be getting documents from DocuSign, and you could start working with them at your convenience. So please don't hesitate to click the button Invest Now and start the investment process. Julia, it's your turn.
Thank you very much. So I am going to moderate the Q&A session. We do have a number of questions coming in through our Q&A chat box. So the first one, Michael, if you could take that one. Can you disclose who the seller is and why he's selling?
Sure. The seller is American Landmark. They are a fairly large company. They own about 35,000 to 40,000 units. They've got 1,000 employees, and they've got properties all over America. So they're basically an institutional player. And they're selling mainly because they are just upgrading their properties. They have about 6-7 properties on the market right now for sale, as I understand it. But they are not exiting multifamily. They also have about 4 properties that under contract for purchasing. They just are buying newer properties. This is an 80s property. They're looking to buy 90s and 2000s properties.
Thank you. So another question we got in several different forms. What is it the expected frequency of distributions, and when do you expect the first payout to be? So I can take that. So we plan to start payouts, distributions in 6 months, and they are going to be on a monthly basis. So that.
And yes, and again, we should remind that our investors get their pref first, and only in a case if something left over, we are getting our fee, our share as well. So we think about our investors first.
Right. Thank you, David. So another question we have is investment horizon. When do you expect to exit, and how are you going to make this decision? Michael?
Yeah, so we always run our projected numbers off of a 5-year hold, and how we exit will all depend on how we're actually operating and performing on the property, and then the market conditions around us. If the market is conducive to selling or refinancing, we'll do at that time. And if the property is operating well and we see other properties around us selling at good numbers, then we'll sell. Otherwise, we'll hold. So the answer is, and Meryl, like this is a lawyer answer, which is it would depend.
Best answer.
Yeah, very good, very good. So Meryl, maybe you could take the next question. Has the property flooded before, and is it in a floodplain?
Sorry, did you want me to take it?
Yeah, I would love to.
So the property has not flooded before, and many of you that are not from Houston probably think that by watching the news several years ago that the entire city was underwater. There were portions of it, but clearly not the entire city. We did go back we're very cognizant and very concerned about buying in flood zones, especially after the flood zones were redrawn by FEMA after Hurricane Harvey. So this one is in the 500-year plane, which is the best plane you can be in the whole Houston MSA. So that means there's a 0.2% chance of the property ever flooding, and that's well beneath what the lender requires and what FEMA requires. So there's no requirement of flood insurance. Long story short, we do not anticipate the property flooding in the next 1,000 years.
1,000 years.
1,000 years.
We're all going to be dead by then, most likely. So another question we have, again, on the equity structure, what's the advantage of Class A over Class D? I can take that one if nobody minds. So there is no advantage per se, and these are just two different equity classes. So Class A is equity, but it's debt-like. And what it means, you're basically getting a coupon. And in the event of the sale, there's no equity upside, but you do have 10% very high coupon. You still get a portion, pro rata share of the bonus depreciation. And another beautiful thing going for Class A, it has priority of payments. So whatever cash flow there is, either operating cash flow or the cash flow at the sale, you get your payment first ahead of classes B, C, and D. So that's class A. No equity upside, but I would say it's a safer investment. Then class B, C, and D, they still have very decent, I would call it high preferred return, but you also do get equity upside. So your average annual return at the end of a 5-year hold, if everything goes as planned, is about 15%. And again, I come from investing in stocks and bonds from, I worked for hedge funds for many years. On a relative basis, considering the alternatives, 15% is just insanely attractive, especially if you add tax benefits to it. It's just nothing compares. Considering especially the resilience of multifamily investment class, because if you look at commercial real estate, all other investment classes in real estate are not doing that great, exception probably the self-storage, right? But the hotels, hospitality is decimated. Retail is not doing that great. Restaurants, people who have tenants as restaurants or retail, it's tough out there for multifamily, especially if you B class, as David has mentioned. It is business as usual. So that's the answer to that question. And next question is, let me see. Yeah. How much is the sponsor team investing in the property?
750,000. That's what we invest as a team.
Thank you, David. So another question I have from the audience is escrow. So can Michael, maybe you could take it. Can you talk about what are the conditions to escrow release?
Yeah, so the conditions of the escrow release are threefold from our guidance from the lender. Number one being whether or not there is any current emergency situation surrounding the pandemic. Is that still in existence? Is that still in operations in that area? So in Houston. The other one is our property, are we able to make the debt service at a 1.25 debt coverage ratio, which is the very typical ratio that we underwrite off of as a minimum. And then the third being, have we performed all of the lender required repairs that they have, which is a list that they come up with when they send out their appraisers before closing. So once we get that cleared up, at that time, they will be able to return the money. So we anticipate that to be anywhere at month 9 or month 12. So it shouldn't be more than 12 months, according to them.
Okay, thank you. So another question we have, do you guys still plan to buy flood insurance for the property? So we do not, because as Meryl explained, and it's 1 in 10,000 years chance of the flood, and flood insurance is expensive. Michael, do you remember the quotes we've gotten recently? You know, it doesn't make business sense to pay so much with such a low risk.
Yeah. It's about 60% higher than the current insurance that we have right now. So,
right, it is a big number. So you know, we obviously considered it, but it just doesn't make business sense for us because we think the risk is so low. There's no reason to overpay. Let me see. What else do we have? Are you worried at all about the oil prices going down and staying low? Can someone comment about that?
Yeah, I'll comment on it. I'm obviously I live here and I've lived here for 40 plus years, and we've been through much, right? And as a younger kid, I went through the 80s recession, which was really bad at that time. That time was really a wake up call for Houston. Houston was probably 70% of the jobs were tied in some form or fashion to oil and gas at that time. But since then, we've been extremely diversified. As for those that don't know, you know, Houston has the largest medical center in the world. The medical center, in terms of square footage, is actually larger than downtown Dallas. I'm not sure even Merrill, you knew that. But so, you know.
Michael, I have one more argument. Let's say that today we all discovered that one of the biggest DFW multifamily operators that is selling a lot of properties in DFW, they move substantial part of their business to Houston. And I just should say that operator that owns more than 10,000 units, they buy in Houston for the reason. They operate more than 10 years. They are very successful, really one of the biggest one. And they are very, very active investing in Houston. So it's not only about oil. It's not only about, let's say, this health corridor. It's not only about diversified economy, but it's also about other even more experienced operators, sponsors than we are. And they are basing their decisions on a lot of analytics, and they move part of their business to Houston. So this is one more.
In the end, all we care about is all the drivers. What does it mean? It means population growth, right? Whether we have the right jobs and the right demographics, stuff like that. And right now, Houston, you know, in one of the charts that I have, it shows that Houston, from population growth estimate between 2020 and 2025, so in the next 5 years, is 508,000, you know, growth in population, which is 7%, which is astounding considering that we're already the 4th largest city in the country. And the second highest is Dallas at 380,000. So, and Dallas has been a powerhouse. Those two cities have been powerhouses for the last decade. So that just goes to show you, regardless of everything, you know, people are anticipating that Houston continues to grow, which in the end is what drives our rent growth in the multifamily space, is the population growth.
And by the way, Michael, I'm checking the numbers for employment growth, and what I see for 2020, from 2020 to 2025, Houston should have 473,000 new jobs, and they're just at the very top of the list.
Yeah,
very simple.
Right.
So we're very bullish about Houston. So
yeah, and I can add to that also. I saw some statistics that showed during the last oil price crash in 2015, 2016, Houston only overall lost 5,000 jobs, which for such a huge metro, it's the fourth largest metro in the whole country. It's just an asterisk. It's nothing. So we don't think, Houston is oil dominated any longer. Obviously oil is a factor, but it's not the driver any longer.
By the way, Julia, and again, it's not about Houston. Let's say Meryl and I, we have our new development project in Leander. And from one side, Leander is near Austin. Yes, it's near Austin. It's almost the same like Katy and Houston. But Austin isn't the fastest growing city in the whole US. No, it's not Austin. It's Leander, the fastest growing city in the whole US, even though Leander just 30 minutes from Austin downtown. Katy and Houston, it's the similar story. While talking about this property, while talking about the submarket, we should talk more about Katy, because average household income, tenants profile, jobs, everything in Katy is much better. So we have chosen not Houston as a place to invest, but we rather have chosen one of the best, if not the best submarkets in the whole Houston. So this is maybe one more explanation why we are comfortable with that submarket, with that area.
Thank you very much.
Any other questions?
Another question. Have you guys? Let's take two more, and I think we will have to wrap it up. One of the questions, a quick question: have you guys worked with Disrupt before?
Yes, they manage 4 properties for us right now.
Okay, thank you.
Julia, one sec. Let me remind our attendants one more time that at the right side of the screen, you could see the button Invest Now. In a case, if you are interested in getting subscription documents, if you are interested in starting the subscription process, please don't forget to click the button and fill the form in order to start subscription process. Thank you.
Thank you. And the last question that I saw in many different variations as well is, can you talk about the sponsor team members' roles and responsibilities? Who wants to take that one?
Well, I can cover it. So obviously we have a very strong team, and we have different roles that we've split up. There's dealing with the various vendors out there. We have dealing with the lenders, dealing with the general contractors, dealing with the property management companies, dealing with the attorneys. So each of those roles, we have investor relationships. There's going to be overlap. So some of the roles that someone has, maybe they take priority over, but everyone else stays involved. All of us are going to be dealing with a property management company. So, but there's going to be a lot of overlap. The one thing I would like to point out is that for the vast majority of us, we've played all of those roles. We've done it all. So this is a way for us to kind of have not a single point of failure, if you will. Everybody can back up everybody else.
All right. Thank you very much, Michael. So with that, we would like to conclude our webinar. We thank you very much for attending. Thank you very much for your time. If you do have any further questions, you have our contact information, so please feel free to reach out, and we would be happy to answer any of the questions you might have. And again, as David mentioned, you should see under offers section, Invest Now button. So if you already decided and now that you would like to invest, then please fill out the form, and we would love to partner with you on this deal. With that, thank you very much.
Thank you.
Have a great evening.
Thank you.